Most seniors across the United States are completely unaware that a new IRS rule is quietly changing how retirement income, stimulus-related credits, and certain federal benefits are reported and taxed. This update is not being talked about enough, yet it has the potential to cause confusion, delayed refunds, unexpected tax bills, and in some cases even penalties for older adults who believe they have done everything correctly. The important thing to understand right from the beginning is that this rule is not meant to punish seniors. It is part of a broader effort by federal agencies to tighten reporting requirements, reduce fraud, and make sure that income connected to retirement, side earnings, and government support is accurately documented. However, when rules change, the people most at risk are often those who rely on fixed incomes and simple filing habits, especially retirees who have been following the same tax routine for many years. What makes this situation particularly concerning is how easy it is to overlook the change. Many seniors assume that once they retire, taxes become simpler. For some people, that is true, but today retirement income often comes from several different places. Social Security benefits, pension payments, withdrawals from retirement accounts, part-time work, gig income, small investments, and even certain government relief programs can all interact with IRS reporting standards. When one small detail shifts, it can affect how the entire return is processed. The new rule focuses heavily on income reporting thresholds and third-party documentation. In the past, some smaller transactions or supplemental earnings were not always reported to the IRS in real time. Now, improved digital tracking and expanded reporting requirements mean the IRS is receiving more information than ever before. This does not automatically mean seniors will owe more money, but it does mean that mistakes are more likely to be caught quickly. Many retirees still remember a time when most income arrived through a single pension check and Social Security deposit. Filing taxes often required just a few forms. Today, retirement looks very different. People are living longer, working later in life, and sometimes earning additional income to keep up with rising costs. Because of inflation pressures over the past few years, more seniors have explored flexible work, consulting, selling personal items online, renting out property, or taking small withdrawals from savings earlier than planned. Each of these actions may seem minor on its own, but together they create a more complicated financial picture. The IRS has been modernizing its systems, and with modernization comes greater matching of records. Financial institutions, payment platforms, and benefit administrators now send detailed summaries directly to federal systems. If a number on a tax return does not align with what the IRS already has on file, the return may be flagged for review. That review can slow refunds and sometimes generate official notices that cause stress for retirees who thought their filing was straightforward. One of the biggest misunderstandings among older Americans is the belief that Social Security benefits are never taxed. In reality, taxation depends on total combined income. When additional earnings push someone above certain thresholds, a portion of benefits may become taxable. The new reporting environment makes it more likely that every dollar influencing that threshold is counted accurately. This matters because many seniors carefully budget their monthly income. Even a modest unexpected tax obligation can disrupt plans for housing, medication, groceries, or travel to see family. Financial stability during retirement depends heavily on predictability, and tax surprises are exactly what most retirees try to avoid. Another factor increasing concern is timing. Tax-related adjustments often coincide with the early months of the year, precisely when many seniors are reviewing their finances after holiday spending and winter expenses. Some retirees are also managing higher insurance premiums or property costs, so clarity about taxes becomes especially important. At the same time, it is essential to remain calm and informed. A rule change does not automatically translate into a financial setback. For many seniors, the update simply means paying closer attention to documentation and ensuring that all income statements are collected before filing. Knowledge is the strongest protection against costly errors. Retirement experts frequently emphasize that the tax system is designed to be progressive, meaning obligations are generally tied to income levels. Seniors with modest earnings often remain eligible for deductions, credits, and protections that limit their overall liability. The challenge arises when reporting gaps create the appearance of inconsistency. Consider how dramatically the financial landscape has evolved. Digital deposits arrive instantly, retirement accounts can be managed online, and benefit adjustments are often communicated electronically. While these changes improve efficiency, they also require retirees to stay more engaged with paperwork than previous generations. There is also an emotional component that deserves recognition. Many seniors feel anxious when they hear the words IRS rule. Even when no wrongdoing has occurred, Official notices can sound intimidating. Understanding the purpose behind regulatory updates can help remove that fear. The government has been placing increased emphasis on accuracy because billions of dollars in relief programs and tax credits have moved through the system in recent years. Whenever large sums are distributed, oversight tends to increase afterward. This is a normal cycle in federal financial management. For retirees who received stimulus-related support or special credits in prior years, keeping accurate records is especially valuable. Some payments were advance credits, while others were reconciled during tax filing. Confusion can arise when individuals forget which payments were already accounted for. Another area drawing attention involves retirement account withdrawals. Required minimum distributions continue to be a critical part of tax planning for older adults. Missing a distribution or reporting it incorrectly can trigger penalties, though recent regulatory adjustments have aimed to reduce the severity for honest mistakes. Even so, accuracy remains essential. Healthcare costs also intersect with tax considerations. Certain medical expenses may be deductible if they exceed specific thresholds relative to income. Proper reporting can sometimes reduce overall tax liability, yet this opportunity is missed when documentation is incomplete. Property-related income has become more common among retirees as well. Some seniors downsize and rent out a former home, while others host short-term stays to supplement income. These arrangements must typically be reported, and the IRS is now better equipped to track them through third-party data. It is equally important to mention that not all changes create burdens. In many cases, modernization leads to faster processing once returns are verified. Electronic filing, direct deposit refunds, and automated corrections have significantly improved turnaround times compared with decades past. Still, preparation is the key theme that every retiree should remember. Gathering forms early, reviewing statements carefully, and avoiding rushed filings can prevent most problems before they begin. Patience during tax season often pays off. Financial advisors often remind clients that retirement is not the end of tax responsibility, it is simply a new phase. Income sources shift, deductions change, and planning becomes more focused on preservation rather than accumulation. The IRS rule reflects this evolving environment. Seniors who rely primarily on Social Security may wonder whether they are affected at all. The answer depends largely on whether additional income enters the picture. Even small amounts can influence how benefits are treated under tax formulas, so awareness matters. Pension recipients face similar considerations. Traditional pensions provide steady income, yet when combined with investment returns or part-time earnings, total income calculations can change. The IRS aims to ensure that these totals are consistent across reporting channels. Another overlooked issue involves filing status after the loss of a spouse. Many retirees experience a shift from married filing jointly to single status, which often results in different thresholds and deduction levels. A rule update can feel more significant during such transitions. Inflation adjustments are another moving piece. Each year, tax brackets and standard deductions may shift slightly. These adjustments are intended to prevent taxpayers from being pushed into higher brackets solely because of cost of living increases. Staying aware of these updates helps retirees plan withdrawals more effectively. Fraud prevention is also a major driver behind stricter reporting. Unfortunately, older Americans are frequently targeted by scams. Enhanced IRS verification processes are partly designed to protect taxpayers from identity theft and fraudulent filings. For seniors who prefer paper filing, the changing landscape may encourage reconsidering electronic methods. Digital submissions reduce manual errors and often allow for quicker confirmation that a return has been received. Family support can make a meaningful difference as well. Many retirees benefit from having a trusted relative or advisor review documents before filing. A second set of eyes can catch discrepancies that might otherwise go unnoticed. It is worth emphasizing that the vast majority of seniors comply fully with tax laws. The goal of the new rule is not enforcement for its own sake, but consistency across a rapidly modernizing financial system. Understanding this context transforms the rule from something intimidating into something manageable. When retirees know what to expect, they regain a sense of control over their financial future. As retirement continues to evolve, flexibility becomes increasingly valuable. Financial habits that worked 20 years ago may need gentle adjustments today. This does not mean starting from scratch, it simply means staying attentive. One reassuring reality is that many seniors remain eligible for valuable tax benefits. Credits tied to age, deductions for medical costs, and favorable treatment of certain retirement income streams can all contribute to a manageable tax outcome when reported correctly. The deeper lesson behind this update is the importance of financial awareness at every stage of life. Retirement should be a time of stability, not uncertainty. Taking a proactive approach helps ensure that government rules never catch you off guard. Throughout the country, advocacy groups continue encouraging older adults to remain informed about policy shifts. Knowledge empowers retirees to protect both their income and their peace of mind. There is also a generational shift underway. Today's retirees are more financially active than previous generations. Many manage investment portfolios, explore entrepreneurial projects, or support younger family members. These activities create opportunity but also introduce complexity that tax systems must account for. For anyone feeling overwhelmed by the idea of a new IRS rule, remember that complexity does not equal danger. Most adjustments simply require attention to detail rather than dramatic changes in behavior. The months ahead will likely bring additional reminders from financial professionals urging seniors to review their records carefully. Treat these reminders as helpful guidance rather than warnings. Ultimately, the biggest mistake a retiree can make is assuming that nothing has changed. Awareness is the strongest safeguard against costly surprises. As this discussion continues, it becomes clear that preparation, documentation, and calm understanding form the foundation of financial confidence in retirement. The new IRS rule may not dominate headlines, but its impact can be meaningful for those who remain unaware. Staying informed ensures that benefits continue flowing smoothly, refunds arrive without unnecessary delay, and retirement plans remain on track. Knowledge replaces uncertainty with reassurance. And perhaps most importantly, remembering that rules evolve just as retirement itself evolves allows seniors to approach these updates with resilience rather than fear.